And now it's time for development debates. We dig deeper into some of the questions shaping the future and present of China. Today, we'll see two experts debate if China's export data in January was exaggerated. Recently, China Customs published the country's export data for January. The report says its export volume has increased by over 10% compared to the same time last year. This figure is much higher than the 4.3% increase from last December. It also is far beyond market insiders' estimates. Although the over 10% export increases in China were quite normal for the past 5 years, this data is still considered dubious because of the widely exposed government scandal from last year. Many Chinese companies manipulated their export volumes to elude government policies. By doing this, Chinese companies can bring more capital into the domestic market. Market watchers point out the fake statistics that would let the export growth rate see significant decreases this January. They believe the export growth rate would be around 2 to 3%. However, the government's data still shocked most of them. An economist from the Royal Bank of Scotland, Louis Coutts, told WallStreetCN.com that he believes Chinese companies are once again manipulating data this year. He cited export data from Taiwan and South Korea to support this argument. Usually, the two economies' export figures can benefit from China's foreign trade businesses. However, data shows that Taiwan and South Korea's export volumes have dropped by 4.6% and 0.2% respectively. Lewis also said that many Chinese companies prefer to increase their product prices for declaration at customs. This method is widely used to increase export volume. But now these companies are using electronic currencies such as Bitcoin to elude the government's capital control policy. Last December, the government forbid third-party payment companies from providing services for Bitcoin trading. But individuals still can buy it without government supervision. Lewis said electronic currencies could also help Chinese companies disguise their capital transfers. Another reason Lewis believes the data is exaggerated is because of the rising renminbi exchange rate. Market insiders believe the appreciated renminbi in the future would let international hot money enter China. The nonprofit institution Global Financial Integrity estimated that during the first half of last year, there were over $100 billion in hot money entering China through fake export invoices. However, the chief analyst of Everbright Securities, Shu Gao, doesn't think so. Shu told AAStocks.com that even January's export data is higher than expectations. It's less likely that Chinese companies once again manipulated the export data. She said that during the first quarter of last year, the export volume data from mainland China's customs was $17 billion more than Hong Kong customs statistics. Meanwhile, the volume of products stored in mainland bonded ports set for export has seen an over 250% increase in January of 2013. Shu points out that these two figures indicate fake export statistics. However, this year, neither of the two figures have seen a situation similar to the previous year. Another reason why Shu believes the figure is accurate is a different export destination from the data in January 2013. Shu said that last year, China's export volume growth rate for three major markets, such as America, Europe, and Japan, were 30% lower than other economies. However, this year, its growth rate in these three major economic entities reached 15%. That's 7% higher compared to other countries. Shu said that the data corresponds well to an economic rebound in these areas. If the figures are down, then it's not a good sign for the Chinese, nor the rest of the global economy. While it is possible and there is precedent for fudged numbers, there is an argument against it. It required deeper investigation and more revealing figures to get to the bottom of the issue.